What if I told you that President Donald Trump, in a single stroke of a pen, just ignited the most explosive trade war of his presidency? A trade war that could bankrupt American families, destroy small businesses, and push the U.S. economy into its deepest crisis since the 2008 recession. It sounds unbelievable, but that's exactly what's unfolding, as Washington imposes crushing 50% tariffs on Indian goods, and India retaliates with devastating precision. This isn't just another trade dispute, it's a full-blown economic war. As of August 6, President Trump signed an executive order imposing an additional 25% tariff on India's purchases of Russian oil. With this new move, the total tariffs imposed on Indian goods has surged to 50%. And it's not just about a handful of products. We're talking about everything from Indian-made shirts, jewelry, and footwear, to a range of chemical products and sporting goods. With 50% tariffs now on the table, it means Indian exports to the U.S. are effectively doubling in price overnight. This decision has sent shockwaves through global trade, and India didn't just take it lying down, they responded with force. India, the world's largest democracy and second-largest buyer of Russian oil, suddenly found itself at the heart of Washington's fury. The tariffs were imposed after India continued to purchase Russian oil, despite the West's sanctions. President Trump didn't hold back, stating, "We cannot allow India to bankroll Putin's war machine." His message was clear. If India defied America, it would pay the price. The impact was immediate and far-reaching. In India, Prime Minister Narendra Modi responded almost immediately, firing back with a strong declaration. India would not compromise its sovereignty or energy security. He emphasized that India's commitment to securing affordable energy for its 1.4 billion citizens outweighed external pressure. Indian newspapers dubbed the U.S. move a tariff blitz, and policymakers worldwide began to assess the potential fallout from such a drastic escalation. But the damage wasn't limited to the diplomatic and political spheres, it's already hitting families in both countries. In the 30 days since the announcement, the U.S. Chamber of Commerce estimates that roughly $87 billion worth of trade partnerships have evaporated. This has led to significant disruptions in critical sectors. For instance, drug shortages have started to appear across the U.S. A pharmacist in Cleveland shared with local media that prices on life-saving medications, including blood pressure pills, have skyrocketed by 35%. Families who were paying $200 a month are now paying closer to $280. Data from the American Hospital Association shows that nearly 40% of generic medications used in the U.S. are sourced from India. With tariffs now hitting this vital import sector, the health of millions of Americans is at risk. But this is just the beginning. As if that wasn't enough, everyday Americans are starting to feel the full weight of the tariffs. From clothing to athletic gear, goods that were once affordable are now climbing out of reach. A New Jersey-based store owner who imports Indian cotton apparel shared with Bloomberg, "I've lost 3 of my biggest retail clients in a month. They can't afford the new prices, and I can't absorb a 50% tariff. I may have to shut down." This is a familiar story for small businesses across the U.S., especially those relying on affordable imports from India. While America has long been a key player in trade with India, the tariffs threaten to undermine one of the U.S. most profitable partnerships. Ironically, when we consider services, America actually sells more to India than it imports. U.S. IT services, aviation contracts, and defense exports to India generate a surplus of around 35 to 40 billion annually. Yet, Trump's aggressive stance could completely derail this mutually beneficial trade relationship. And the economic toll doesn't stop at small businesses. Analysts from the Penn-Wharton budget model estimate that this trade clash could shrink U.S. GDP by as much as 8% and slash wages by nearly 7% over the next 2 years. The Tax Foundation has projected that the average U.S. household could pay about $1,300 more in 2025 alone due to rising prices from these tariffs. Economists like Jennifer Lee from Capital Markets have noted that these tariffs effectively serve as a tax increase on middle-class families, disguised as foreign policy. The White House justifies these tariffs by arguing that India's alignment with Russia, along with its ties to Brazil, Russia, India, China, and South Africa, BRICS, poses a threat to global economic stability and undermines U.S. dollar dominance. The U.S. government sees India's continued purchase of discounted Russian oil as directly funding Putin's war effort, which goes against the West's sanctions. Critics, however, argue that Trump's move is a major diplomatic blunder. Former Treasury Secretary Larry Summers stated, "Targeting India with a blanket 50% tariff is catastrophic diplomacy. We're punishing our own consumers while isolating a critical ally." What began as a political move to punish Russia has now escalated into a full-fledged trade war with a country that has long been considered a natural ally of the U.S. The warning signs of this escalating trade conflict were evident even before the August 6 announcement. On August 1, the Trump administration rolled out a blanket 25% tariff on all Indian imports, citing national security concerns. This was a bold move, signaling Washington's willingness to inflict domestic pain to send a message abroad. But India refused to bend under the pressure, instead doubling down on its energy purchases from Russia and accelerating its deals within the BRICS bloc. Trump responded with even greater force, escalating the tariffs to a whopping 50%. For Washington, the energy ties between India and Russia had crossed a red line. India's purchase of Russian oil was seen as an open defiance of U.S. policy, and the Trump administration made it clear that there would be consequences. The fallout from this decision has been swift and severe. The energy crisis, the pharmaceutical shortages, and the strain on small businesses are only the beginning of the economic consequences of this trade war. In the next sections, we'll explore the far-reaching impacts of these tariffs, how India has strategically retaliated, and the global implications that may forever change the dynamics of international trade. While the Trump administration initially believed it could force India into submission, the reality has proven to be far more complicated. India's retaliation has been swift, strategic, and calculated. The country is not just defending itself, it's rewriting the rules of global trade. One of India's first major moves was to target the pharmaceutical sector, an area where the U.S. has long relied on imports from India. The United States imports over $10.5 billion worth of pharmaceutical products from India each year, including essential medications such as heart medications, insulin, antibiotics, and chemotherapy drugs. With tariffs now sharply increasing, India began imposing restrictions on the export of critical drug ingredients and generics. Within weeks, U.S. pharmacies began reporting shortages. In cities like Houston, a mother explained to CBS News, "My son's asthma inhaler went from 45 to almost 70 in just 2 weeks. I had to call 3 pharmacies before I could even find one in stock." The shortages continued to escalate, with common medications increasing in cost by as much as 35% within a short time. The American Pharmacists Association stated that nearly 40% of generic medications used in the U.S. come from India, and this supply disruption has left millions of Americans vulnerable. This is not just an inconvenience, it's a full-blown crisis. Hospitals have reported critical shortages of vital medications, including antibiotics and insulin. Dr. Karen Lopez, chief medical officer at a Boston hospital, told local news outlets, "We cannot just flip a switch and source insulin from another country overnight. This supply chain is built on Indian production, and now patients are paying the price." The pharmaceutical crisis is only one part of the broader economic fallout from the trade war with India. The technology sector has also felt the sting. India is home to one of the world's largest IT workforces, and for years, U.S. tech giants have relied on India's vast pool of engineers and offshore teams. However, in retaliation, Indian IT service providers have raised rates for U.S. clients by as much as 20%. At the same time, India has begun offering discounted contracts to companies in Europe and Asia. This has put immense pressure on American tech firms, which are now facing skyrocketing costs. According to research from Gartner, U.S. companies are now looking at an additional $12 billion in IT costs by the end of 2025. These higher costs are inevitably passed on to American consumers in the form of more expensive software, apps, and electronics. One Silicon Valley executive, speaking anonymously to the Wall Street Journal, admitted, "We underestimated India's leverage. This is a nightmare scenario." And then, the agricultural sector, which had already been struggling due to the ongoing trade war, took another hit. India has long been one of the largest importers of U.S. agricultural products, including soybeans, wheat, and corn. However, in retaliation, Indian buyers abruptly canceled large contracts and began purchasing from suppliers in Brazil, Argentina, and Australia. This sudden shift in the market has caused a financial disaster for American farmers. Tom Reynolds, a third-generation farmer in Iowa, shared his frustration. "I had 50 bushels of corn contracted for India. They backed out overnight. That's nearly 400 in lost revenue for my farm. I don't know how we survive this year." The U.S. Department of Agriculture confirmed that roughly $2 billion in corn and soybean export revenue evaporated in just weeks, and the ripple effects are being felt across the agricultural industry. This is a crisis for U.S. farmers, but the impact extends far beyond the fields of the Midwest. Grain elevators across Kansas and Illinois are reporting storage gluts, and local prices for crops are plummeting. The consequences are being felt in rural communities, where businesses like restaurants and stores are seeing their hours cut, and local economies are starting to collapse. The U.S. agricultural sector isn't the only one suffering. In the financial system, India has delivered yet another blow to American dominance. As a member of BRICS, India has already been moving away from dollar-based trade, and in response to the tariffs, Indian banks have accelerated this shift. By late August, Indian banks began settling more transactions in local currencies like the rupee, Chinese yuan, and UAE dirhams. Some exporters even turned to cryptocurrency to bypass the U.S.-dominated SWIFT network. This development has caused panic among U.S. financial institutions. Banks like J.P. Morgan, Citi, and Wells Fargo, which typically make billions in transaction fees and foreign exchange profits, are suddenly seeing a portion of U.S. India trade routed elsewhere. This could be a long-term threat to U.S. financial dominance, with the potential to erode the dollar's standing in global markets. The broader financial impact is also felt on Wall Street. Financial analysts are now predicting that the ongoing trade war with India could shrink U.S. GDP by up to 8%, with wages projected to drop by 7% over the next 2 years. The Tax Foundation estimates that American households will face an average additional $1,300 in cost by 2025 due to higher prices on imported goods. Economists like Jennifer Lee from Capital Markets argue that these tariffs amount to a hidden tax on middle-class families. The U.S. economy, already dealing with inflation and slow growth, is now facing the repercussions of an all-out trade war with one of its largest partners. And the longer the conflict drags on, the more devastating the consequences will be for the average American consumer. As the trade war with India intensifies, the economic shockwaves continue to ripple across the U.S. economy, and it's becoming increasingly clear that this conflict is not just about tariffs, it's a full-scale reordering of global trade. India's retaliatory actions have been carefully targeted to strike at the heart of American economic strength, and the consequences are becoming more severe by the day. One of the most disruptive moves India made was to target the U.S. tech sector. With one of the largest IT workforces in the world, India has long been a key player in providing tech services for American companies. Major U.S. firms like Microsoft, Google, and Amazon rely heavily on Indian engineers, developers, and offshore teams for everything from software development to customer service. But in retaliation for the tariffs, India's IT service providers have started raising their rates for American clients by as much as 20%. This is not just a minor price hike, it's a massive increase that will result in millions of dollars in additional costs for American companies. At the same time, India has been offering discounted rates to European and Asian firms, further shifting its trade focus away from the U.S. and towards new global partners. This has put enormous pressure on American tech companies, which are already grappling with rising costs. Experts from Gartner Research estimate that U.S. tech firms could face an additional $12 billion in costs over the second half of 2025. These higher costs will inevitably be passed on to consumers in the form of more expensive software, apps, and technology products. A senior executive from a Silicon Valley-based company admitted anonymously, "We didn't see this coming. India has leveraged its position better than we anticipated, and now we're paying the price." The ripple effects of these moves are spreading throughout the technology sector. For consumers, the impact is already visible. Subscription prices for software, cloud services, and digital tools are rising, and new product launches from major tech firms are likely to carry higher price tags. This could have a devastating effect on U.S. consumers who are already struggling with inflation. The effects of India's retaliatory tariffs extend beyond just the tech and pharmaceutical sectors. The agriculture industry in the U.S. is also feeling the heat. For decades, India has been one of the largest buyers of American agricultural products, including soybeans, wheat, and corn. But in the wake of the trade war, India has pivoted away from U.S. suppliers and turned to other countries like Brazil, Argentina, and Australia for its food imports. This shift has already caused significant losses for American farmers. One farmer in Iowa, Tom Reynolds, shared his story. "I had contracts for 50 bushels of corn that were supposed to go to India, but they canceled overnight. That's nearly 400 in lost revenue for my farm. I don't know how we survived this year." U.S. Department of Agriculture data confirms that, as of August 2025, roughly $2 billion worth of corn and soybean exports have disappeared due to India's pivot to other suppliers. The impact on local economies in farming regions is catastrophic. Grain elevators in Kansas and Illinois are reporting storage gluts, and the price of crops has been plummeting as demand drops. Many small towns, where farming is the backbone of the local economy, are beginning to feel the effects of the lost revenue. Local businesses are reporting declining sales, and some are even shutting down due to the economic slowdown. But perhaps the most alarming development in this trade war is the impact it's having on global financial systems. India's decision to push for non-dollar trade has sent shockwaves through the financial markets. As a member of BRICS, India has accelerated its push away from using the US dollar for international trade. Indian banks are now settling a significant portion of transactions in rupees, Chinese yuan, and UAE dirhams. In fact, some Indian exporters have even begun to use cryptocurrency to bypass the US-dominated SWIFT network. For Wall Street, this is a nightmare scenario. JP Morgan, Citigroup, and Wells Fargo, which have long relied on the dollar's dominance in international trade, are now facing billions in lost transaction fees and foreign exchange profits. As one financial analyst put it, India's shift away from the dollar is a direct challenge to American financial dominance. This could be the beginning of a long-term trend that undermines the dollar's role as the global reserve currency. The Federal Reserve is already showing signs of concern, with interest rates on U.S. Treasury bonds rising as investors begin to look for safer alternatives to the U.S. dollar. Analysts are warning that, in the long run, this could lead to a decline in the dollar's value, which would have a devastating impact on U.S. consumers. The price of imports would rise, and inflation would become even harder to control. So, what does all of this mean for everyday Americans? Well, the impacts are already being felt across the country. Pharmaceutical shortages, rising tech costs, higher food prices, and stagnating wages are just the tip of the iceberg. And the longer the trade war with India continues, the more entrenched these problems will become. In addition to the direct economic pain, this trade war is also hurting American businesses. Many small businesses that rely on cheap imports from India are now facing extinction. From retailers to pharmacy owners to manufacturers, businesses are being squeezed by the rising costs and the uncertainty that the tariffs have introduced. Take, for example, Ann May Apparel, a small business in New Jersey that imports Indian cotton clothing. The owner shared with Bloomberg, "I've lost 3 of my biggest retail clients in just a month. They can't afford the new prices, and I can't absorb a 50% tariff. I'm going to have to shut down if this continues." This is not just a few isolated businesses, this is happening nationwide. From coast to coast, small businesses are feeling the pinch. And the middle-class Americans who once had access to affordable goods are now finding themselves unable to keep up with rising prices on everyday products. The economic turmoil caused by the escalating trade war between the U.S. and India is far from over, and the ripple effects are beginning to hit global markets in ways no one could have predicted. While the U.S. administration may have anticipated that the tariffs would force India to back down, the reality is that India's response has not only mitigated the damage but, in many ways, has turned the tables on Washington. What's happening now is a clear demonstration of how India is reshaping global trade, positioning itself as a powerful force that will no longer be easily intimidated. One of the most significant aspects of India's counterattack is its strategic shift towards alternative trade agreements. By moving away from U.S. dollar-denominated trade, India is positioning itself as a leader in the emerging multi-currency trading system. India, as a member of the BRICS bloc, has accelerated efforts to establish a new trading framework that could undermine the dollar's dominance in global transactions. In just a few short weeks, India has made major strides in settling more trade deals in rupees, Chinese yuan, and even cryptocurrency. This move could have long-term implications for the US dollar, particularly if other countries follow suit and begin to prioritize non-dollar currencies for international trade. As the BRICS alliance grows, with countries like Indonesia and Nigeria signaling interest in joining, the potential for a new multipolar trade system becomes increasingly likely. The power dynamics within global commerce are shifting, and the rise of non-dollar trade has the potential to disrupt the current financial system that has been dominated by the U.S. for decades. Mark Zandandi, chief economist at Moody's Analytics, warned that if India continues pushing this alternative trading system, the U.S. could experience a death by 1,000 cuts as more countries abandon the dollar in favor of their own currencies. The long-term effects of these changes could be profound. In the short term, however, American consumers are already bearing the brunt of the trade war. Prices on everyday goods continue to rise, and inflation remains a significant concern. The U.S. government has scrambled to respond to these challenges, but solutions are slow to materialize. President Trump's economic policies, which were initially hailed as a way to protect American workers, now appear to be backfiring in spectacular fashion. Wall Street has also taken a major hit. As India diversifies its trade partners and moves away from U.S. dollars, American financial institutions are seeing a decline in transaction fee revenue. Banks like J.P. Morgan, Citi, and Wells Fargo are losing billions of dollars in profit from cross-border transactions. And as the U.S. dollar weakens, the costs of importing goods will only increase, further squeezing American consumers. But the effects on American businesses are perhaps the most alarming. Small businesses, especially those that depend on affordable imports from India, are finding it increasingly difficult to stay afloat. From retail stores to restaurants, businesses are being forced to raise prices or close their doors altogether. The pharmaceutical sector remains a major point of concern. With India being a key supplier of generic medications to the U.S., the drug shortages that have begun to emerge are a direct consequence of the tariffs. These shortages are causing real harm to American families, especially those who rely on life-saving medications. The tech industry is also feeling the heat. India's retaliation, which has included higher fees for IT services, has forced American tech companies to rethink their strategies. Silicon Valley giants are now grappling with higher operating costs, which will inevitably be passed on to consumers. From software to cloud services to consumer electronics, the cost of U.S. tech products is on the rise, and the innovation that the U.S. has long prided itself on is now at risk of slowing down. Meanwhile, American farmers are facing the fallout from India's decision to cancel large agricultural contracts. This isn't just affecting farmers in the Midwest, it's also shaking up the entire agricultural supply chain. Corn, soybeans, and wheat staples of American agriculture are suddenly facing a massive drop in demand. This could result in major losses for U.S. farmers, many of whom are already dealing with the fallout from the ongoing trade war with China. In response, U.S. lawmakers from both parties are calling for action. Senator Elizabeth Warren criticized the trade war for hurting working families, small businesses, and farmers, saying, "This reckless policy is not just hurting the economy, it's hurting the heart of America." On the other side of the aisle, Republican Senator Chuck Grassley expressed his frustration as well, saying, "Farmers in my state are being sacrificed for a political stunt. The White House's strategy is failing, and we need to take action to protect American workers." The American consumer is at the center of this economic storm. A Tax Foundation analysis found that the average American household will pay $300 more in 2025 alone because of the tariffs. Prices are rising on everything from groceries to medications to consumer electronics. A family in Ohio expressed their frustration to the Washington Post, saying, "We are paying more for everything: groceries, medicine, even streaming services. It feels like we're being punished for a fight we didn't start." The worst part? No one seems to have a clear solution. The White House's efforts to shield American consumers from the fallout of the tariffs have largely been ineffective. The Federal Reserve has already reduced its growth forecast, predicting that the economy will shrink by 2.7% in the third quarter of 2025, the worst performance since the depths of the COVID-19 pandemic. And with consumer confidence hitting a 15-year low, it's clear that the American public is losing faith in the government's ability to resolve this crisis. So, what does all of this mean for the future? The answer is still unfolding, but one thing is clear. The trade war with India has already begun to reshape the global economy in ways that will have lasting consequences. As India strengthens its ties with other emerging economies and continues to push for alternatives to the U.S. dollar, the traditional financial power structures that have dominated global trade for decades are beginning to crack. For the U.S., the cost of this trade war is becoming too high to ignore. Whether it's rising prices, supply chain disruptions, or global financial instability, Americans are beginning to realize that the real cost of this conflict isn't just economic, it's also about losing the global leverage the U.S. has enjoyed for generations.